Hello and welcome to the Money Show, your one-stop destination for your personal finance queries. I'm Kavita Thapliyal, and today again we have a power pack show for you where we'll be talking about markets and investments, and we will also answer your mutual fund portfolio queries. And just in case you're watching the show live, you know what you have to do. Just in case you want to get any financial strategy done from our experts or any exclusive recommendation for your financial goal, you can send across your question on our WhatsApp number, which is 8657974571. We also have an email ID, which is themoneyshow@etnow.tv, where you can send across your questions. So any financial goal related question, all you have to do is just send across the details, and you can mention your investment details in terms of mutual funds or even your insurance policy, anything related to your financial portfolio. We have our experts giving you live financial planning advice. Okay, so let's begin the show. Despite the global volatility and tariff-related uncertainty, Indian equities posted a robust recovery in almost April, if we have to see. The Sensex and Nifty rose almost 3.5%, mid-caps outperformed, FIDI flows remained strong. Even with weak small-cap sentiment and global growth headwinds, domestic confidence seems to be returning, fueled by softer inflation and rate cuts and signs of improving private capex. Now, given this backdrop, would you say India is entering a new phase of the growth cycle, or are we still in a fragile recovery? Let's discuss. I have with me Venugopal Manghat, CIO, Equity, HSBC Mutual Fund. Mr. Venugopal, hi, good evening, and welcome to the Money Show. And let's begin with decoding the market trajectory, where April definitely we saw a very strong gaining momentum. Do you see the resilience over here sustaining, over through June as well? Or do you think it was almost like a short-term relief rally that we witnessed? In terms of, if I want to ask you about things beyond June also, Nifty valuations are now, in line with their 5-year average, with earnings downgrade for current year 25-26, and the current levels are very attractive. Should investors stay cautious? How do you see the markets right now?
Yeah, good evening, and thank you so much for having me on the show. As you rightly said, we've had a good rally in the month of April and May as well. It continues, on the positive side. This is coming after, a few months of correction, quite severe correction, I would say about 17% on the Nifty, which is a fairly large number when you consider a bull market. Whenever this type of a recovery phase comes, it usually looks like a relief rally. It starts like that and then it builds on. So I think a lot of the factors that played, with negative impact from September onwards have turned around to some extent, to a large extent, I would say, barring the global factors. And therefore the markets are trying to look forward for the positives and the growth that is likely to come in the next financial year. As you know, markets are always forward looking, and hence we've kind of already factored the worst in terms of economic growth of the last year. And the markets are looking forward now for a better year in FY26. However, I think there is no room for unbridled optimism, given that the global uncertainties remain. I don't think there is, we can escape that in the near term. There is a pause on the tariffs announcement, and there is a lot of negotiations going on between, different countries with the US. However, there is no finality, there's no clear sense of where this is going to finally land. And to that extent, I think the uncertainty continues. And more importantly, the uncertainty on how global growth is likely to play out, over the next year or more. So we need to still get answers to a lot of those questions, and therefore I'm saying that don't go by the pace of this recovery and the market rally in the last 30-40 days. Be cautious, but we're more positive in the medium to long term.
Right. Let's also focus on specific sectors. What about sectoral shifts and sectoral churn that you are witnessing? Oil and gas, FMCG, banks, consumer discretionaries, we see are, getting a lot of momentum, including defense now as well. What, according to you, is going to be the leadership trend in terms of sectors? And do you think the already doing well sectors could also dominate, or you think there's going to be a sector rotation, especially talking about June and the forthcoming months now?
Yes, I think what we've seen so far is the investments team dominating for maybe 2 years or 3 years rather, till I think maybe September of last year, or maybe the beginning of last fiscal year. And for the right reasons, there was a slowdown, and for known reasons, and we all know about that. And I think that has moderated the performance of the investment team and the sectors within that. It's a wide range of sectors, including manufacturing and infrastructure investments, etc. The stellar run that these sectors had over the last 3 years till the beginning of last fiscal year has moderated to some extent, given that there's been a bit of disappointment on the government capex side for last year, and continuing a little bit. And earnings growth is also therefore moderated, especially for financial year 2025. We saw earnings growth slowing down for some of these sectors. My sense is that given that this is probably one of the large themes which has multiple sectors within it, which most of these sectors have high correlation between them, and therefore move together and create the beta therefore in the market. It becomes the most powerful theme, and that's what we saw in the 2004 to 10 cycle, and we saw in the last 3 4 years as well. Um, Having done whatever it had done in the last few years, with the moderation now, I think the market is grappling with leadership for the next few months or quarters. uh, there's still this disappointment that the capex is not picking up on the private side, and government capex is kind of moderating. So my sense is that there will be sector rotation, which will play out in the near term. I think calendar year 2025 will see a lot of movement between sectors. We saw already, some of that, and you mentioned consumer staples. That's, I think, a technical rally or a relief rally from the kind of pounding that it saw. There's a bit of relief coming from the input prices getting better, and there is an expectation with the monsoons, being expected to be good. There's an expectation of a recovery, so we saw that. We saw IT playing out in the past, and then a decline, and then again IT doing well in the very recent past. And banking obviously had underperformed for a very long period of time. In the last few months, that's also done well. And going into the quarterly results of Q4 results, banking did fairly well. The results were also quite good. So I think, and that's one of the sectors which where there was a little bit of relative undervaluation. So that did very well. Now we see we are expecting the consumer discretionary sectors to pick up over the next 2 3 quarters. My sense is probably in the September quarter and going into the December quarter, we will see consumer discretionary sectors getting better with the tax cuts that we saw in the budget, and the interest rate cuts that we've seen so far, a 50 basis point cut, more to come hopefully, and all of that, and with the monsoons and the strong agriculture produce expected low inflation environment, I think the consumer discretionary sectors should start gaining over the next few quarters. So we will see sector rotation this year. I don't know, however, whether on a medium to long term basis, the trend of investments taking leadership can change structurally for consumer discretionary to take over. I think that will take a slightly longer term horizon.
All right, let's also talk about small cap over here, a category investors are really interested in. So given the weak performance of the small cap index, despite a broader rally over here, do you think it's still a very risky space or a value opportunity, as we move towards the second half of this calendar year? How are you viewing this space?
So we've always liked the small cap part of the market. We believe strongly that this is the space which can deliver, which can get you alpha. This is a space that is underinvested, underexplored. There are not too many analysts tracking a large number of companies in this space. This space actually offers the widest range of sectors and stocks in the market. The universe is the largest, and to that extent, I think offers far more opportunity to identify companies and let them grow over time to become larger. In that context, we think that there is significant opportunity in the small cap space, despite what we've seen over the last 2 or 3 years and the outperformance from the small cap side over the Nifty and the large cap indices. Um, my sense is that the current recovery has been more in the large cap part of the market, and I think the broader small cap universe has not fully recovered. I think with the parameters and with the factors changing to a more positive note, especially the liquidity aspect in the system improving very significantly, with the central bank actually taking a lot of measures. With growth coming back again, we've seen Q4 growth picking up, and we expect, Q3 December quarter GDP growth picking up. We expect Q4 to be also good, and going forward into financial year 26, we expect the growth to really be better. The GDP is expected to be somewhere in the range of 6.2 to 6.5% growth in financial year 26. And that with the fact that we have two rate cuts already, more to come. We have inflation being at its lowest point. Balance sheets are very, very lean with no leverage at this point in time. And growth opportunities are plenty at this current juncture, with government incentives and low taxation, etc. So I think all in all, the environment is very conducive for small companies to really grow faster. And therefore, we are quite positive on the small cap side over the medium to long term. We believe this is a good opportunity to identify companies and to invest, and therefore we look at this as a opportunity.
All right. I want to also understand how are you looking at the last quarter earnings and what kind of an indication are you getting, in terms of sectors and companies for the upcoming first quarter of the new financial year? Your take on the earnings numbers.
Yeah, so I think the last quarter results have been fairly in line or maybe marginally better, I would say. Especially if you look at the broader universe, if you look at the Nifty 500, for example, the growth has been much better than the Nifty itself. I think I mean, there were some disappointments. Obviously, every quarter you will have those disappointments, and I think um, the expectations going into Q1 of FY26, the big question to answer is how would the globally sensitive sectors or sectors which have global linkages, perform in the first quarter and going beyond into the second quarter. That's the key question, because IT as a sector has a reasonable weight in the index. Apart from that, you have oil and gas and metals. So all of these have global linkages, and we don't know the actual impact of whatever has transpired till now with respect to the tariffs. How has that impacted the actual economy and demand? So my sense is that the first quarter results will give you some indication, though not so much clarity. However, I think the domestic sectors are likely to do significantly better. I think government capex is continuing to improve, especially on sectors like you mentioned, defense, and, the metro rail side, power transmission and distribution. All of those sectors are doing fairly well. Apart from that, as I already mentioned, we are quite positive on the consumer discretionary side, given the tax cuts and the interest rate cuts that we've seen, translating to better demand for, for goods and services from the consumer side on consumer discretionary side. So I think first quarter will be better than probably the Q4 of this year. Last year base, I think, was still about 11% for the Nifty. So on that base, I don't know whether you'll get a significantly higher number, but overall, it should be a continuation of the same trend of improving earnings growth.
Sure. Do you see any kind of a red flag as far as private capex recovery is concerned? We are looking at earlier monsoon now. We are yet to see whether monsoon is covering all parts of the country or not. That data, only then as and when we reach there, we'll get to know. But so far, it's an early monsoon. How should long-term investors, according to you, be placing up their portfolio in terms of market caps, also looking at the red flags and also the green shoots as far as the market is concerned?
So, as far as red flags are concerned, the concerns, I would say, largely stem from the global side. I think the tariff-related uncertainty and the, more importantly, growth, is the key concern that we have currently. It's largely a global issue. I think the domestic factors are far more positive currently. I already spoke about most of them. And hence, I think long-term investors should continue to build their portfolios. We continue to like the broader markets, which is the mid and small cap range. We believe that's where the opportunities lie to create alpha and create wealth over a longer period of time. There will be these short phases where you have the larger caps really outperforming small caps, with risk appetite waning, and with uncertainties looming around. But I think on a longer term basis, small caps will continue to outperform large caps. So longer term investors should look at identifying or should be in funds or identify stocks within the small cap basket, which are part of good teams and good businesses run by good people, and stay invested for the longer term. And I'm quite positive on the consumer discretionary side over the next 5 to 10 years, given the fact that the per capita GDP is expected to increase significantly from the current $2,700 or $2,800 that we have currently. As we go from this $2,700 to a $5,000 per capita GDP, I think the consumer discretionary demand should improve quite significantly. Multiple parts of the consumer discretionary chain have very underpenetrated sectors, and many of these have very large unorganized markets as well. So there's a huge opportunity that is unfolding, and that is being, that you can see unfolding over the next several years. And this space also has a lot of, or companies in the space are largely small caps or mid caps. And I think given the large population and the aspirational population that we have, with per capita GDP rising, I think over the next 5 to 10 years, that's the place where you can create maximum wealth.
All right, I think that will be all. Thank you so much for being on the show today, Mr. Venugopal, and helping our viewers understand the market trajectories going ahead. Thank you so much.
Thank you.
If you like this video, then like, share and subscribe to ET Now.